Hi, good evening, everyone. Welcome back to the channel. In this one, we're going to discuss strategies YieldMax can implement to eliminate Nav erosion and hopefully observe a relatively high dividend. So let's get right into it. So, there's a few things that they've told us. And by the way, just to kind of promote it, I guess Mike is coming back on tomorrow. So anyway, there are a few things that YieldMax can do to preserve the NAV and that they're not doing yet. Let me announce the Discord that I'm live here. Okay, so you all may remember Jay used to say manage your shares, right? Which that was kind of like a, you know, trite statement, I guess. But managing your shares, he would talk about how you should reinvest the dividends. Basically, I personally don't reinvest dividends. I'm not a big fan of that, but he talked about maintaining the share count. I don't really see what the point of that is at this point because all these funds do is drop. So even if you have a stable share count, the statement basically implies reverse splits because if you think about it, as the reverse splits happen, your shares get cut in half. And then if you're taking the dividends and getting more shares by reinvesting, your share count can stay somewhat stable, but at some point, where does the increase happen? So let's go over, as I've been trying to do in most of my videos, let's go over what AI says. I like to incorporate this. So some of the things they can do, I just did a quick, AI, Google Gemini output here. So they claim YieldMax has begun shifting strategies to mitigate NAV erosion, a common issue with high-yield synthetic covered call funds. They all pretty much have it. By incorporating more diversified active management techniques rather than relying solely on pure zero-date expiration synthetic options. Well, they weren't doing zero-date expiration to begin with, to my knowledge. Key strategies include using collar options, which buying protective puts alongside selling call options, and investing in lower volatility large cap equities to stabilize capital. So the collar option strategies, instead of just calls, and funds like Ulti started doing this in the summer, and it looked like it was working for a little while, but it just keeps dropping because the whole market seems to be shit right now anyway. Hey, welcome, dividend degenerates. I know there's like 3 live streams going on with people that we watch, so it's tough to pick which one. But anyway, I'm trying to ignore MSTR and stuff like that right now. I just don't want to focus on it. So anyway, so funds like Ulti are increasingly using collar strategies, which involve buying protective puts to mitigate downside risk while still generating income from selling call options. Increased diversification strategies are shifting away from high volatility single stock, zero date to expiration synthetic positions to include more diversified, lower volatility equity holdings, reducing the impact of a single stock's decline on the overall NAV. So that's important, and I would even segue into the discussion with leveraged ETFs. I'm not a big fan anymore of like the leveraged ETF strategy. I think that especially with individual securities, it's tough. Individual securities, there's way too much single stock risk. And going forward, I think I'm just going to do it with basically indexes like NASDAQ, S&P, which I do think, providing that the NASDAQ does go again, I think TQQQ is a great buying opportunity right now. So the strategy shifting away from high volatility single stock zero date expiration synthetic positions to include more diversified lower volatility equity holdings. So that's something. Active management and rebalancing. YieldMax now often employs a more active approach to managing the synthetic long positions, adjusting allocations to better manage risk during market volatility. And then leveraged put spreads. Some strategies utilize leveraged put spreads to attempt to gain upside potential while protecting against significant downward movements in the underlying asset. These adjustments aim to improve price stability and make the high distributions more sustainable, though the funds still carry risks related to high yield synthetic option-based strategies, of course. Okay, and then I have an article I want to pull up over here from Seeking Alpha. To address NAV erosion in YieldMax ETFs as of 2026, investors and the fund advisor have adopted several structural and active management strategies. These range from internal fund overhauls to external portfolio allocation tactics. the target 25 funds to combat aggressive NAV decay of ultra high yield funds. YieldMax launched the target 25 series. So I guess I don't really buy this because then you would have to basically buy the target 25 funds on top of it, including Test and NVIT. These funds target a fixed 25% annual yield and reinvest any surplus gains back into the fund to maintain the NAV. That's why they always say, when I said, can't you just create? And they did. They responded to what the community asked for them to do by creating the target 25. But I don't think anybody's buying these, because why would you buy this instead of curve funds or instead of Roundhill or Rex shares? What's the competitive advantage? I guess I'll ask Mike. By the way, for the hundreds of you that are on right now, submit your questions to me for Mike tomorrow. If anybody has any really good questions, he was supposed to be on today, but I had to push him back a little bit, unfortunately. But yeah, let me know what your questions are. I'll definitely ask, because I get it that their response was the target 25, but what's the big draw? What's the competitive advantage? Why would someone pick YieldMax target 25 over what they could have somewhere else? So let's see here. Strategy overhauls for Ulti. Some funds have transitioned from purely synthetic covered call positions to more complex option strategies. For instance, Ulti now allocates up to 50% to large cap, lower volatility equities and utilizes collar strategies, which is buying protective puts, and leveraged put spreads to provide better downside protection. Now, they were talking about launching something called YieldMax in the summer, but we never heard anything else about it. And then tax loss harvesting. The advisor may exit specific underperforming positions to harvest tax losses, then immediately reinvest in the same synthetic strategy to maintain market exposure while minimizing capital gains distributions that would otherwise further reduce NAV. But how do you avoid the wash rule? I guess if you're a fund, you avoid the wash rule. Interesting. Well, that's a stretch, but I guess that is one. Investor-led mitigation strategies. Investors often employ active management of their YieldMax holdings to offset the natural grind lower typical of these products. Strategic reinvestment. And this is one that Jay used to talk about. Many investors advocate for reinvesting a portion of the distributions, often suggested as the excess yield above 20 to 30%, back into the fund to keep the principal stable. I mean, we've asked for this for a long time. This compensates for the price drop that occurs on the ex-dividend date. The 70-30 or 80-20 rule. Some strategists suggest allocating 70 to 80% of a portfolio to broad market index ETFs like SPY or QQQ. I'm a fan of that. And using only 20 to 30% for high yield YieldMax funds. This balances the high income with the underlying growth of the broader market. However, I personally think 20 to 30% is too high. Transitioning to index-linked funds, some investors shift from single stock YieldMax ETFs to index-linked versions like QDTY or SDTY, which may experience less severe erosion than individual volatile stocks like MSTY or Coney. Key performance comparison. Okay, this is what I want to go over. The following table, by the way, if you're on, I think there's like one of you now, just smash that like button for me. That would help me out. Let me tell Discord I'm live again. Hang on. Okay, so let's see if we can get, a few more people here. All right, so the following table highlights the difference in capital performance between aggressive single stock strategies and target or index strategies as of late January 2026. So for Chippy, so capital gains since inception, 31.39%, annualized yield, 38.8%. And then, okay, they're going to show index ones. So Soxy, the target 12, that's the one that the guy that actually rang the bell said he's invested in, 31.90. Target 25 Tesla, 25.86 yield. Capital gains 1.95%. NVDY yield 38%, minus 26.62% capital gains. YieldMax 46%, capital gains 53.07. So basically, the audience or the customer for YieldMax would be somebody that needs like massive amounts of cash up front. But then if you're going to do that and it's just going to basically be your own money, why not just basically say, okay, here's $100,000, put it in a checking or savings account and just withdraw the money yourself. I don't see the point if it's just going to drop. It's kind of like where's the money going? People ask that. People that don't really understand the stock market, they say like, where does the money go? So if I start out with 100,000 and I lose 50,000 of it, where does the 50,000 go? Well, to the other end of the transaction, I guess. Um, okay, let's see here. I want to pull up this article. This is a pretty good article here. I want to piggyback off of here. All right, so we're going to switch over to Seeking Alpha here. Ulti, doubtful that the strategy change will reduce NAV erosion, and they downgraded it, which I respect, actually. I agree with this. YieldMax, hold on. YieldMax Ultra Option Income Strategy ETF is downgraded to hold following a major strategy overhaul aimed at reducing NAV erosion. Ulti now allocates, we just went over this, up to 50% to large cap, lower volatility equities, blah, blah, blah. Despite a almost 70% yield, persistent. This is a recent article too. Persistent NAV erosion and shrinking distributions raise concerns about long-term sustainability and income reliability. Frequent return of capital distributions and amplified downside risk from leveraged temper enthusiasm making Ulti more suitable if the yield stabilizes near 40%. And then we have a picture of an angry-looking dog. Remains extremely popular among income investors due to its high dividend yield. I see that line way too many times. And its diverse portfolio of holdings. When I previously covered Ulti, I issued a buy rating due to the strategy change and management's attempt. Oh, he's covering his bases a little bit. Management's attempt at implementing a way to hedge against market declines. Since then, the fund's share price has declined by more than 33%. And even when including all distributions paid, Ulti still sits at a total loss of 11%. Since my last coverage, management has yet again implemented another strategy change that overhauls the fund's approach, and we didn't cover this. On December 8th, Ulti now aims to get away from the specific focus on stocks that have high implied volatility. Instead, Ulti now aims to take a more balanced approach that aligns with better price stability. I should have covered this when it happened, over a longer holding period. So any performance graphs that are dated before December 8th will not reflect the new strategy. Okay, I'm having deja vu here based on this chart. So it's showing total return stabilizing. Remember, the same thing happened in the summer. But again, it also has a lot to do with the underlying market. Looking at the performance over the past year, we can see Ulti share price has eroded by 58%. Even when including all distributions paid out to shareholders, the total return sits at a loss of 2.8% over the same time frame. Despite the shifts, Ulti continues to offer investors a massive starting dividend yield of almost 70%. Okay, so that's about the strategy shift, but I'm not really buying it because I saw the same thing over the summer and it stabilized until it started dropping again. Let's see here. We've got Ben Hover. Coach, I have been watching you for a while now, and I appreciate all the information you share with us. It's informative and helpful, but YieldMax has stolen more money from people than I would have ever. Yeah, I mean, I understand that take for sure. Pirate Justin, welcome. I just saw you on the other live stream. Is that over? How about MSTR? Speaking of stealing money, I feel like somebody's stealing my money because, I mean, MSTR, like nothing's going up at this point. All these AI stocks, we were told AI was supposed to be so great this year. Were we lied to, or was it already over? But anyway, I'll cover Ulti more in depth. I've got Mike coming back on tomorrow. This was kind of a precursor to, what they could possibly do. Anyway, that's going to pretty much do it for this one. Thank you all so much for tuning in. Please like, comment, and subscribe, and join Discord, and keep following me. Appreciate all the support. Thank you all, and we'll see you all tomorrow. Ciao, ciao now. Bye.